¿Qué lo que, mi gente? It's Dylan King, aka Mr. Moves. Do you fear my pen? In this video, we're gonna go over how to use a moving average. There is a lot of videos out there of people teaching moving averages in either a very complicated way or shit you really don't need to know, you know what I'm saying? Or a very simple way where you're gonna use it and lose money. So I'm gonna teach you how to properly use a moving average and identify a moving average that you would like to use for your particular day trading style. The different moving averages there are, some calculations of them, what makes sense to you for your anxiety level when it comes to trading. Because moving average crossovers are not it, all right? They usually get you into the trade late, unless you have moving averages such as mine that don't do that, right? There's a reason why I made them that way. But the ones that you get, like simple moving average crossovers, exponentials, either get you in too fast, false breakouts here and there, and you want to get caught up in that. So in this video, I want to go over just how to use a moving average, identify it, different settings, etc., etc. Let's go over to the charts. All right, guys. So in this video, I'm not going to try to overcomplicate it, try to make it real quick. We're going to go over what a moving average is and how to use one. So a moving average is a line that plots on your chart that gives you the average of current price data. So you will hear reference to the 200-day period moving average, the 20, the 50, the 100 period day moving average. And all that means is majority of the time traders like to trade the daily chart. So they're referring to the amount of candles that moving average is calculating. So let's plot the three most commonly used moving averages, and as time progresses, I am going to introduce you to others that we actually have built into the DON itself. There's so many. There's the Hull, there's the JMA, the SMA. There's so many moving averages that you can learn about that calculate price differently. So right now we have the simple moving average, and right now it is set to a period of 21. And what does this mean? That right now on US 30 on the daily time frame, it is calculating the average price of 21 candles. What you have to know about all moving averages is they are what's called lagging indicators. And what a lagging indicator is, it does not predict future price movement, but only adjusts based on past price movement. So if I were to rewind from right here, right, you can see that as price already broke up above here, the moving average is just catching up here, and as price continues, boom, you can use it as an entry signal. Now, another thing that's good for moving averages is they act as what's called dynamic support and resistance. If you haven't seen my support and resistance video, please go check that out. But basically, at the end of the video, I go over real quickly how you can utilize it, right? It's basically a moving support and resistance. In conjunction with a combination of other ones, you can use it as entries and to see zones, right? So for example, here you have a lot of rejections, and the moving average is moving real close to price, and you can see it's rejecting and rejecting, and you can start using this as your moving support and resistance and your bullish engulfings, or however you want to use your entry signal, right? Rejected here, you could have entered and caught all that, and then once it breaks down, it acts like support, right? Broke, retest, broke back up, came back down, and then here you go, right? And you can see here as price danced above it, boom, you could have entered off these rejection points, and you're here, and you would have caught this. So with the 21 period simple moving average, this one's mostly used for longer period trading because it's an average of just strictly whatever period you set it to. Now, another famously used moving average you can use is the EMA, exponential moving average. And if I place that on the chart, you can see that's the white line. You can see the calculation behind this moving average is slightly different. So even though it's calculating the same 21, and of course you can change it to any number that you want, it is calculating closer to price. So compared to the simple moving average, the exponential moving average can move a little bit faster to price. And this is one that's more commonly used on lower time frames to react. Even though it's still a lagging indicator, it reacts to price change a little bit faster. So you can see that how the green line, which is the simple moving average, is kind of floating above, but the exponential, when it crossed the same point here, actually followed price a little bit closer. So another moving average that's also used is the weighted, and we made this red, and you can see that it is exactly that. if it's weighted and it's way closer, it's pretty much on top of price in either direction. Now you can see that it's stuck to price like a glue, and it actually moves closer to price compared to the other ones. How can you use the exponential simple for entry signal? Now, if I were to jump down to, let's say, the 1 hour time frame, and I got the simple moving average, what people like to do, and you can see how it crosses, the lower you make your moving average, the faster it is. So if I made this 10, it is calculating, it's going to start calculating the past 10 candles compared to current price, right? And you can see how price changed, it got a lot quicker. So if I added another moving average, right, and I made this period, let's say 21, I can start using this as signals, right? So the green one is my 10, my 21 is the slower one compared to the 10 because it's calculating more price data than the other one. Now you can also use it in conjunction with the 200 moving average, and I'm also going to plot another one real quick. So 200 will show you the overall trend in the market. If you have we went over how moving averages can be used as dynamic support and resistance. The 200 period moving average is used to show the overall trend of a market on a current time frame. So now it's calculating 200 candles, and of course it's going to move a lot slower compared to the other ones because it's calculating more candles than it is. But if you were to look across, you can see how it reacts to price as a major dynamic support and resistance. Resistance, support, support here, resistance, support here, support here, resistance broke through, became support. You can see how it can be used as a really good dynamic support and resistance. This is kind of like teaching you a strategy and also teaching you how to use moving averages to your advantage. So what lower periods from like 0 to pretty much 21 that's famously used can calculate short-term trends because they are reacting to short-term price. Now, if I were to put another moving average such as the 50, this is one that's used for mid-term price trend. So you can see that this is the 200 is the long term, and the 50 period is our short-term, mid-term price trend identification. So you can see that it's calculating only 50 candles of price, but it's giving you a better overall trend. So how can you use this conjunction with 4 simple moving averages for price entries? Well, 200 is now at this point right here is resistance. It broke through. We had our buy signal right from beneath it. We had our buy signal. We got the cross right beneath it. Price broke, retested our 200, which is it became support, and now you can enter for the buy because we have a confirmation of now. Not only did it break resistance, became support, price is above the 200 moving average, right, which is one and the same what I just explained. We had our buy signal from down here, and our 50 period moving average is showing us the midterm to possible long-term price trend, right? So we could have entered here, used our ATR. If you haven't seen my ATR video, click the link above to check that out, how to calculate your stop loss and your take profits, and got a nice little entry here. Now, you can also use moving averages again, or moving dynamic support and resistance. So you can use the 50 period, preferably better, to see where your price can possibly pull back. So because it's a lagging indicator, how I've always been able to identify certain periods where price may come back to is my moving averages. So you can see, right, we got that breakup, and then you also know that price has to pull back at some point. When the 50 period decides to finally get here, I can identify this point, this point, this point, this point, this point, all the way to my left. If you haven't seen my support and resistance video, go check that out, because again, all these moving averages are calculating past price data. The only differences to make is what type of moving average you use, which one that you're comfortable with, and what's your trading style. If you are someone that likes to hold positions for a decent amount of time, a simple moving average will probably do better for you because it gives you a better average of price without giving you fake outs and stuff like that, such as the exponential or weighted that reacts to price data a lot faster, right? So, you know, play that through and you can see how price rejected off that 50 period, rejected again, and then price continued to go in that direction. Even though it did break down a little bit, the 200 period is acting as your major support, and then you still have confluence to enter on that cross, broke above the 50, and then you could definitely enter right over here for the rest of that trade, right? And again, I didn't cherry pick. I'm giving you guys live examples here, right? So that is how to use the simple moving averages, right? So let's start putting a whole bunch of exponentials on the screen so you can see how, in comparison, how those work. Let's put some on the screen here, right? So let's put the 21 period on the screen, and then let's make it another 50, and then let's make this one 100, and then let's also make this 200, right? So we have our 21, 50, 100, and 200 period moving averages, exponential moving averages. Now let's go back to where price was before, right into this example. Compared to the simple moving average, you can see that price is actually a lot tighter, right? A lot tighter. And let's keep it consistent actually. Let's add another exponential because I actually want to get a little bit more in depth, and let's put that 10 back on, right? Just put that 10 back on, and let's make that one blue, right? Stuck on price. And what the exponential can really help with is assets that are very volatile, such as US30, especially when using on the 5-minute time frame. Now, here's how I want you to learn how to identify price volatility. You see how I have all these different combinations of the same EMA. I have the 10, which is calculating price data of the last 10 candles, the 21 period, 50, 100, and 200, right? As price gets more volatile, these moving averages spread. If you were to take your hand and make it into a fist and then spread them wide open, think about it just like that, showing you how volatile price is going or can be the more it spreads, right? And all of these, all the space in between each moving average can react as a zone within itself. Why is this important? Because once you start getting really good at utilizing indicators, and of course, right, I don't teach basic moving average crossovers because of course the Don itself is really a moving average crossover, but it's a little bit more advanced than what I'm showing here. Most moving average crossovers actually get you into late signals, but look, compared to the simple moving average, that actually got you in at this, the exponential got you in on the break of this long candle, right? You get in a lot faster. And why? Because the exponential is actually reacting to price a lot faster. So when price comes back and reject, we went over how you can get entries off the 50 period moving average, right? And then that one candle here broke down, but look where it rejected off, the 100 period moving average. So now as it accumulated again, you can also use the sandwiching of moving averages to identify ranging markets when you have a system of them together. And these are widely known, right? I'm not teaching nothing new. You know, the combination of these exact numbers are widely known. You can see when they sandwich, you have accumulation. When they spread, you see volatile movement. When they sandwich, you see accumulation. When they spread down, you see volatile movement, and it's just reacting off price data. And you can use these as dynamic rejection zones, right? So as price on the 10 comes down, is testing that 21, you know, if you trade bullish engulfings, that's a good entry, right? It broke down here and you want to identify, like, should I keep holding this trade? Well, you have an exponential moving average that's moving extremely fast, right? So I wouldn't rely on that 10. Maybe the 21 and then the 50. If it broke from my 50, I'm gonna have to look up to my left. Institutional candle, long candle has to come correct. If it rejects off my 50, right? I think it's a Morningstar pattern, right? You can enter on that. And hopefully you guys see how you can use moving averages more than just, you know, simple moving average crossovers, right? And then this is kind of cool. What happens is when you get reversals, right? You master market structure, you master support and resistance. If you haven't seen my market structure video, go check that out, right? This area right here, price broke, and now where price is now accumulating between the 100 and 200 period moving average, rejecting from the top, rejecting from the bottom, right? And then if I go cover this and then just extend this left, this zone, the tops of these zones, right? So you can use this, and it's very powerful if you learn how to really just identify how to use indicators properly instead of just, you know, getting buy and sell signals from, you know, fake algo companies. So if you learn how to use them, they're really, really good assets. So look, let's go, boom, and get rid of that. Let's add some weighted moving averages and do the same thing, right? So let's 10, 21, 50, 100, 200. Now, can you guys spot any difference between the exponential and weighted? It is so tight on price, right? It is really, really tight on price. You're gonna be subjected to a lot of fake outs. Even the 200 period moving average, you're gonna get faked out a lot. You're gonna get faked out a lot. And not to say this isn't a good moving average. It can be, in conjunction with other ones, can be really, really good, right? Still acts like your dynamic support and resistance, but it reacts to price data a little faster. So where can you use this where it can be a little bit more effective? Well, if you're a scalper, this is probably your dream because it just reacts really well. Same rules apply, right? If you have your shorter term moving average crossing over a longer term moving average, it gives you buy and sell signal. Then you use the other higher ones to confirm trend direction. And then there you go, right? Real tight snipe entries here. But if you're not careful and if you don't have experience in the market, you can get faked out a lot, right? You can get faked out a lot. But you can see on pairs such as US 30 on the 5 minute, shoot, we can even go down to the 1 minute, and you can see how you can utilize it to enter real snipe entries comparatively to a smooth moving average. If I was just to, not a smooth moving average, a simple moving average, right? Let's just make this one, 21, and let's make it white and really bold. Right? That's the 21 period weighted. That's the 21 period simple. And look at the difference between price catching. It just gets you in. The weighted gets you in real snipey. Real snipe, real tight, close to entry. And that's why I recommend, if you're using a scalping strategy, exponential or weighted is probably best friend. If you're trading higher time frames and you're holding positions a little longer, then a regular moving average, simple moving average might be better for you, so you won't get whipsawed out of trades. So that's just a quick video of understanding simple moving averages, the three basic ones, right? You got your simple, weighted, and exponential moving averages, and the more famously periods that you can set to identify trend direction. In this next video, we're gonna start going over how to use a baseline and how to trade with the trend. All right, guys, if you found that video helpful, drop a like for me, smash it, smack it, do whatever you got to do over there. In the description down below is my TradingView, my Instagram, my Discord, my free Discord, the free signals and chat, and my 7-day free trial. You get access to absolutely everything. You know, like everything, you know, indicators, algos, bots, my daily calls. I think I said signals already, like everything for 7 days. All right, see you guys in the next video.
Don't need me no friends. Bag on my head and they wanted me dead, but you still see me with the roof of the Benz. My bitch is bad and bougie. Ain't but a back, she don't matter to me. Super big guns like it's Call of Duty. Say this your man's, but he ratatouille.